In 1982, something quiet happened on Wall Street. The U.S. government changed a rule. Overnight, companies were allowed to buy back their own stock on a massive scale without being accused of market manipulation. 4 decades later, stock buybacks have become one of the largest forces in the entire economy. Last year alone, U.S. companies spent hundreds of billions of dollars buying their own shares, not building factories, not raising wages, not lowering prices, buying themselves. Here's how it works. A company earns a profit. It can reinvest that money into new products, workers, or expansion. Or it can use the cash or even borrowed money to purchase its own stock on the open market. When it does that, the number of shares shrinks. Fewer shares, same company, earnings per share go up. And since executive bonuses are often tied to earnings per share and stock price, you can see the incentive. The company looks more profitable, even if nothing fundamentally changed. Investors cheer. The stock rises. Index funds automatically buy more. Retirement accounts swell. It feels like growth. But here's the uncomfortable math. Since the early 2000s, buybacks have often exceeded corporate spending on research and development. Some companies have borrowed billions just to repurchase shares, increasing debt while boosting stock prices in the short term. So the market rises, executive compensation rises, asset